Welcome to the London Property Podcast, your go-to source for navigating the complex and ever-changing London real estate market. Our digital marketplace provides informative and educational content from industry leaders through podcasts and videos. We cover various aspects of the real estate experience, including buying and selling, finance, law, tax, construction, design, and more. Join us as we delve into the latest trends and developments in the market and gain valuable insights from our panel of experts.
Hello and welcome to London Property. I am your host Farnaz Fazaipour, and today we're delighted to welcome to the show Rob May of SPF Private Clients. And the subject today is going to be centered around insurance, and specifically we're going to speak about inheritance tax. So just before we delve into our full conversation, I think both for Rob's sake and my sake, we must make it clear that this is not official tax advice. This is insight shared between two property professionals who have exposure to people who are asking questions and looking for solutions to do with inheritance tax. And Rob is talking to us really in his capacity as a insurance broker and not a tax advisor. So now we're going to pass on to Rob in order to tell us a bit more about himself before we dive into the discussion. Welcome to the show, Rob.
Thanks very much, Farnaz. Delighted to be here today. Thanks for having me on the show. So I guess a little bit about me. How did I sort of come to you today, and you know, a bit about my background. So I've been in the what I would refer to as the higher value life insurance space now for just over 12 years. So basically all of my career post graduation in financial services. Originally sort of joined a business where I was a more generalist financial advisor. So following that more traditional financial advisory path, and not long into my career, found myself in a business that I guess, you know, for my benefit now, looking back, was very much involved in large life insurance policies and securing those for clients where they needed them as part of their inheritance tax planning. So I ended up getting involved in quite a lot of that by default, and actually quite enjoyed it, and much more so than I did looking at things like pensions and investments, which was perhaps the more kind of traditional forms of financial planning that most advisors were looking at. So I kind of created a bit of a niche for myself, really, and yeah, I haven't looked back since. So yeah, as I say, 12 years on into my career, that's what I've been doing for pretty much all of that time now. Moved around a couple of firms in the meantime, but joined SPF just over 2.5 years ago now to sort of drive that proposition forward within the business.
Well, we certainly have a lot of colleagues in common, so you're doing something right, because all the people I would turn to for high net worth individual advice seem to be common friends between us. So tell us a bit more about a scenario where life insurance can be used and it's helpful for planning for clients.
Yeah, absolutely. So as I mentioned, you know, my focus predominantly, or where I see life insurance being utilised mostly for clients, is inheritance tax. So perhaps let's start there, particularly with the budget behind us now in October, which of course itself has brought into, at least months to come, some big changes to inheritance tax legislation. So from an inheritance tax planning context, at least, life insurance is really utilised as a mechanism for protecting tax exposures and allowing them to be funded in the event of then a death that arises that ultimately triggers that tax bill. So rather than maybe other forms of inheritance tax planning, past and present, which you know, very much often driven towards avoiding paying a tax bill, life insurance is very much about paying a tax bill, but just using the proceeds of that policy to fund it. So if we take a couple of simple scenarios, if I have a client that maybe, or let's say a married couple who on the second of them to die, there's maybe an inheritance tax exposure, what they could look at is something known as a joint life second death insurance policy that would be set up such that then when that second death arises, there is an amount paid out and made available to the beneficiaries of their estate, ultimately to fund either part of the tax bill that arises or potentially all of the tax bill that arises, depending on the amount that's insured by the policy. Another common scenario, perhaps as well, is in relation to lifetime gifts. So if clients maybe have gifted an asset to another family member, perhaps a child, they may well then have an exposure to inheritance tax for 7 years. So life insurance is commonly used in that scenario to protect that 7-year exposure, and to match what we call taper relief, so where the liability reduces down over that 7 years. So it's really about, as I said, funding tax bills. But I guess beyond inheritance tax, there are, of course, multiple applications for life insurance. So, I think generally any client that has dependents, whether that's, spouse, children, whatever, should ultimately have some form of life insurance in place just to ensure that there's some liquidity left behind in the event that they sadly pass away, either prematurely or at any point perhaps. Equally, maybe businesses have a need for life insurance. So perhaps a business could have a key individual within that business organization. And in the event of that person's passing, actually, there is a big hole left behind, not just emotionally, but also financially. So that's where life insurance could also be utilized. And actually, with my SPF hat on, thinking about the big part of SPF, which is actually driven by mortgage businesses, of course, life insurance can be utilized to protect other liabilities like a mortgage liability. So lots of different applications, but that's perhaps a summary of a few to consider.
Yes, I was going to ask that actually about the mortgage. So you mentioned it before I got to it. So when is it a sensible and good value to take out when would a person really benefit from that? Because obviously, the older you get, I guess, the more expensive it gets. So what would be your advice to someone who's planning and looking at this as the kind of perfect timing for doing something like this?
Yeah, I mean, all joking aside, I tend to say to clients, if you can take out life insurance, in your 20s and 30s, and that's absolutely when you should in theory do it. In reality, of course, though, none of us think that far ahead in life, and none of us take those steps, generally speaking. So I find that really the time that life insurance should be considered is more triggered by your own personal circumstances, possibly life events, things that ultimately mean it's absolutely necessary that you look at a life insurance policy. So if we're talking in a sort of more general planning context, that could be you just had a child, and so actually you want to make sure that there's some life insurance to protect your family. It could be triggered by something like a mortgage. So maybe you just bought a property, you've got a mortgage liability therefore, and you want to look at some life insurance in that respect. In the context of inheritance tax planning, it tends to be driven by a few different factors. So if we take the scenario that I mentioned earlier about protecting gifts and inheritance tax on gifts, and naturally that's triggered by someone that's actually already made or is about to make a gift, and so they look at that specific type of life insurance at that stage. Or just more generally, we find that maybe clients get to a sort of age in life where they then start to naturally think about things like inheritance tax planning, so possibly into their 50s and 60s. If we're talking about clients that are sort of UK centric, it kind of falls in line with maybe things around pensions and retirement planning as well. So that kind of triggers those conversations. But equally, if we're talking about maybe a big swathe of clients that have been impacted by the recent budgets and non-UK domiciled individuals, actually what tends to trigger that conversation is more, around things like there's a legislative change, therefore they might have an inheritance tax exposure going forwards when maybe they wouldn't have had previously. Or indeed that actually, a client has perhaps just moved to the UK or just left the UK, and circumstances like that can ultimately drive the conversation. But in terms of, cost effectiveness and, trying to get a good deal, so to speak, from a life insurance perspective, we find our average client age, mainly driven by the fact that we're doing inheritance tax related work, is around the 50s, when they're in their 50s. And at that age, it's still incredibly competitive. I would argue it can also be incredibly competitive at any age. But of course, naturally, as one gets older, the pricing increases. And in addition, the longer one leaves it in life to take out life insurance, the greater the likelihood of other circumstances happening in the meantime, which may also have an impact on perhaps the pricing that's available. So, for example, maybe someone sadly suffers from a medical condition, and that medical condition can then potentially impact on the premium that they pay, or possibly make it impossible to obtain life insurance. So that's always a consideration, and why I sort of, as I said, joking aside, suggested that all clients should try and get life insurance as early as possible in life.
Get it before you're old and ill is the message. Not to laugh about something like that, but that's kind of the takeaway that I'm getting, because I was going to ask you, what are the potential challenges associated with arranging life insurance for clients? Is that part of it, where they are in their life journey?
Absolutely, yeah. So ultimately, when we think about life insurance and life insurance premiums, most importantly, those premiums are driven by a multitude of different factors. So at a very basic level, age is the key factor, and the amount of insurance that you're wanting to actually take out is another key factor. However, beyond that, you're then also into things like health, lifestyle, and the impact of things around that can then influence what the premium ultimately payable is. So, for example, the difference between someone that maybe is a non-smoker versus someone that does smoke, that can have an impact, and that's sort of a lifestyle factor, so to speak. We could be talking about medical conditions, for example, some of which actually wouldn't have any impact whatsoever, but some of which can have a very material impact. Obviously, the severity of, say, a medical condition influences the impact that it can have on life insurance underwriting and premiums. Equally, other things, from a lifestyle perspective. So we find that we get a lot of clients with some interesting hobbies. So maybe, clients that have a history of, or perhaps still participate in things like motor racing or sailing or heli skiing. And those sort of factors that then naturally, because of perhaps by comparison to the standard population, there is an increased risk there. Insurers, perhaps will charge a higher premium to mitigate or offset their exposure to that increased risk, and therefore that potential for an untimely claim arising from a life insurance perspective.
So I'm imagining there's quite a busy time for you at the moment with all the talk around inheritance tax in the marketplace. So I'm going to ask you twofold question before getting to what market trends are you seeing, is what were, just for our listeners, what were the major changes in inheritance tax recently announced?
Yeah, so I guess what I should say is I'll caveat that this shouldn't be seen as formal tax advice. So, do please take proper advice before acting on anything that we talk about today. Yeah. But as a very brief summary, and I guess the key headlines from an inheritance tax perspective, and particularly those impacting my world as well. So coming in April of 2025, there are changes to what we would perhaps refer to as the non-dom regime or non-UK domiciled regime. So the changes coming in there are the concept of domicile, at least from an inheritance tax perspective, is largely disappearing, albeit not completely. There will still be some nuances as to when domicile is important. But the headline is that instead of a client being resident in the UK for 15 years, before they become exposed to inheritance tax on their non-UK assets, that period is reducing down to 10 tax years. So if someone's been tax resident in the UK for 10 of the last 20 years, then actually they will have an inheritance tax exposure on all of their assets worldwide that they have in their personal names. So that's quite a big change. So in addition to that, then we've got clients that have offshore trust structures that they may have set up in the past. And those offshore trust structures, until next April at least, will completely mitigate inheritance tax exposures on the assets that are held within those trust structures. However, the changes that are coming in mean that inheritance tax, whilst it won't be an exposure in the event of a death of the person that set up that trust, it will trigger a potential 10 yearly charge, or periodic charge as it's known, and also potentially an exit charge as far as the assets that are held in that trust are concerned. So some quite big changes coming in from that perspective too. That's in relation to existing trusts. The change, however, really impacts clients going forward. So if we've got clients that haven't already got offshore trusts in place, unlike historically, going forwards, they will not be able to use offshore trusts to protect against inheritance tax in the event of death, to the extent that that individual also still retains an interest or a benefit in the trust that they set up. So quite a technical point, as I said, caveating earlier, it's important that clients take formal advice on these points, because it does get into some very technical detail when it comes down to it. So those are the key headline changes, at least impacting the non-dom regime, so to speak. We've also seen changes, or we will see changes in relation to pensions. So at the moment, at least, pensions in the UK are not caught by inheritance tax. But as of April 2027, so a couple of years away yet, they will be brought within the scope of inheritance tax, so treated like all other assets within a client's estate. So that's a big change. And then furthermore, there'll also be some restrictions from 6th April 2026, so just over a year away, around things known as agricultural property and business property. So essentially, those assets at the moment qualify for 100% relief from inheritance tax. So there's no inheritance tax exposure on such assets. What is proposed to come in from that date are restrictions such that there's a £1 million allowance for 100% relief on those assets, but anything above that will have an exposure of 20%, so half of the standard inheritance tax rate. So yeah, those are the key changes coming in. Now, what impact is that going to have on me? I mean, to put it bluntly, we've already started seeing, increasing inquiries coming through for clients impacted by one or potentially all of those different changes that are coming in. The key thing, of course, as I mentioned earlier, is that, a lot of those clients will therefore be looking at life insurance as a solution to help protect that tax exposure and fund it in the event that a tax exposure or tax bill does arise.
That was very educational. Thank you for that, because I keep getting asked this question. In fact, yesterday I was asked by someone who's based in DC, who's got a property in Paris that they want to sell and buy one in the UK, and wanted to know if they'll be exposed to inheritance tax, to which I said I don't think so. Because if you're not resident here, presumably none of it would apply.
The key point really around inheritance tax is, where are the assets? Okay. And also, what is the status of the individual? So if we think about the new rules, if someone is considered long-term resident, then it doesn't matter where their asset base is, because they will be caught by inheritance tax on a worldwide basis on personally owned assets. Okay. But if we've got someone that is not long-term resident under the new rules, they will only have an inheritance tax exposure on their UK situs assets. So typical scenario would be maybe someone that lives in somewhere like the Middle East, Far East, but they own a UK residential property, which of course is pertinent to our conversation today. So they will have an inheritance tax exposure on that UK residential property. Right.
Even if they're not living here and they're just using it as a holiday, whatever.
Exactly. Yeah. So there's only really one scenario where that they might not have an inheritance tax risk on UK residential property, and that's perhaps where clients have, when they first purchased that property with a mortgage, and that mortgage may offset the value of that asset, that property, to the extent that actually then the net value, so the amount of the value of the property less the mortgage, falls within then reliefs and allowances that they have available where there is no inheritance tax. So for example, let's take a married couple. Between them both, they have up to 650,000 of nil rate band allowance, as it's known. So no inheritance tax on up to 650,000 of assets between them. So if you've got a client that, say, purchased a UK residential property valued at 2 million, and let's say that they've got a mortgage of 1.5 million, then the net value of that property is only 500,000 and therefore falls within that combined allowance. So they wouldn't have an inheritance tax exposure there. But, when it's talking about much bigger numbers or clients that haven't bought with a mortgage, then inevitably there's likely to be an inheritance tax consideration or concern to think about.
Not to act like we're tax advisors here, but I wonder whether if there's a double treaty, so if you are American and you are covered worldwide by the American system anyway, whether there's a treaty where you're exempt from paying the inheritance tax in London.
So in relation to property, residential property doesn't apply. Okay, that's always been my understanding as well. Let's caveat again that we're not tax advisors, but yeah, absolutely, that's always the case with residential property as far as I'm concerned. We probably shouldn't get into the weeds on double tax treaties because that's beyond the scope of
we're definitely not those experts.
Of my knowledge. Yeah, exactly.
No, I agree. So just before we thank you for your time today and the insight that you've shared, I want to just get an idea. So you are in your 50s. And let's go with two scenarios. One is that you're leaving the UK and potentially for the next 10 years, if you die, you're going to have to pay inheritance tax here, correct? So you can take out insurance that I won't have to pay inheritance tax in the UK if I die within the next 10 years from when I left the UK. And I'm a healthy person. What kind of figures am I looking at per month? And my other question is, once you're in a policy, then obviously it's the cheapest way is to keep paying that policy rather than coming out of that policy and trying to get into a new one, correct?
Generally speaking, yeah. I mean, obviously, individual circumstances may dictate something different. So I guess where sometimes we might see a difference to that answer would be perhaps someone that's taken out a policy when it was very recently post, quite a significant medical event. And so perhaps they attracted quite a heavy rating, so to speak, from an insurance perspective. So it may well be that person that attracted that, higher premium than standard could be better off than in 3-4 years' time revisiting matters and having a new policy underwritten, which is then perhaps available on a much better underwriting terms and also therefore potentially a better premium, subject to, of course, the impact of age that might have had an impact in the meantime as well. So yes, generally speaking, once you've got a policy, it's very difficult to replace it at a more competitive premium, but there are circumstances like that where it can be possible.
And what sort of rates would you be looking at for a healthy 50-year-old who's now left the UK and wants to protect themselves for the next 10 years from IHT?
Yeah. So if we're talking about someone looking specifically at a 10-year term, and let's assume that they're non-smoker, accepted on standard underwriting terms, so the best rate possible from a UK perspective at least, then roughly per £1 million of cover as an individual, they might be looking at just over £1,000 a year as a premium. It's pretty competitive at that age. And actually, in fact, even if we look at, say, a 60-year-old, you're probably looking at just under £3,000 a year for £1 million of cover as well. Those premiums broadly are proratable as well. So if we were looking at, say, 5 million or 10 million, you could multiply that by, say, 5 or 10 to get roughly to sort of some indicative premiums. That's, of course, individuals. If we're talking about clients where they're married and actually the exposure to inheritance tax is therefore deferred until both husband and wife or spouses have died, then in fact, we look at a joint life second death policy, which I mentioned earlier. In those circumstances, the cost per million for, say, a 10-year term, if both were age 50, you're looking at about £570 a year. And if both were age 60, it's about £1,400 a year. So, yeah, some pretty competitive rates available at a base premium level. And I think that's why, obviously I'm going to sound biased, but I think that's also why life insurance is important to explore, even when clients do have perhaps some medical history or some other factors that might influence premiums in a negative way, because the base premiums can be so competitive that even when you build in the potential for perhaps non-standard premiums due to things like health, then actually your starting point is very good. So even with the additional premium built in for perhaps your individual circumstances, it can still work out to be a very competitive way of protecting that tax exposure.
So I'm guessing that the IHT protection is going to be slightly different to IHT and a mortgage protection, because they've got to then pay the mortgage off. So that's going to be a more expensive premium.
So technically speaking, the answer is no. So obviously the nuance will be you might be looking at a different type of product in terms of how long the policy lasts, and also whether that policy has an amount or a sum insured that stays the same, increases or decreases over the time period that the policy is in place. That's where you see the differences between, say, protecting a mortgage perhaps or protecting an inheritance tax exposure. But the underlying rates for life insurance policies are all the same. So it doesn't matter if you're taking out, say, a 10-year policy for £1 million and you're using that to protect a tax liability or a tax exposure, the pricing of that is going to be exactly the same as it would be if it was just being used to, say, provide liquidity to protect your family or to be used to protect a mortgage liability, because ultimately the underlying product is still the same. It's just a life insurance policy.
Okay. And final question. So for our listeners to know, when is a good time to speak to you, I'm assuming that a lot of what you do, you get contacted probably with wealth planners, tax advisors, tax lawyers. Is that generally how a client will end up knowing about what you do and how it can help them?
Yeah, absolutely. I mean, that's a good point to make as well, is that we find so many clients haven't got a clue or even awareness that this solution exists. They may well be aware that there is, life insurance is available, but to connect that with perhaps things like inheritance tax, it's very unusual for a client to be aware of that until, someone does make them aware of it. And that typically, from our perspective is coming from, say, them visiting their tax advisor or their lawyer or, maybe their private banker, for example. And the conversation starts around inheritance tax planning, and it's the other advisor that then sort of brings up the concept of maybe that's something that for them to consider. So yes, that's typically how our business does come to us. But I think realistically, where could we make a difference? I think education is the key thing. So just making clients more and more aware of this as a solution. I think the more and more we do things like this, for example, hopefully it spreads the message. But in terms of when clients should be thinking about it, again, I think I'll go back to my earlier point, which is really it's kind of triggered by life events. So my key point though is that clients should think about it sooner rather than later. So there's nothing worse than when I get contacted by a client that has already made a gift and they then want to protect that 7-year exposure. And they're on my case, wanting me to get that policy sorted as soon as possible so that they haven't got that risk completely unprotected. Well, in a perfect world, at least, when a client is thinking about making a gift, then they would contact me or, their other life insurance advisor well in advance of them making that gift. And that would allow them then time to get through the underwriting process, get the policy offered so that by the time the gift is made, the policy can actually commence and then everything's neat and tidy and they've got no exposure unprotected. So yeah, I think whatever you do, if you're listening out there, instruct or at least get in contact with your life insurance advisor as soon as you possibly can, and bring them into conversations with your other advisors as well. I work best when I'm working collaboratively with other professionals, be that a tax advisor or a lawyer, because ultimately we bounce off one another in terms of, thinking about the broader planning, thinking about, where my solution fits in with maybe that broader planning, and where perhaps there's also gaps in maybe my knowledge where I need the other advisor to help, to help provide advice around things like the tax, things like double tax treaties, etc. So yeah, I think involving us all together is important, and ultimately for a client's benefit means that they get the best possible outcome.
Good to know. I'm about to do a transaction where a father's gifting something to a son. So, hey, you never know. Well, actually, at London Property, that is really very much what we're about. We make educational content that helps people manage their property wealth. So we will definitely be back in touch with you when our members need your assistance. So thank you so much for your time. This was really informative and very topical. It seems to be all over the news. So Thank you, and we look forward to welcome you back to the show when we've got some other things to discuss.
Brilliant. Thanks so much, Farnaz. Really appreciate your time, and great to be here.
Thanks for tuning in to our latest episode of the London Property Podcast. Head over to our website where you can browse our exclusive network of top experts driving the market. As a member, you'll have direct access to our experts and their networks. Our award-winning content will help you choose the right professionals for your needs and make informed decisions about your investments. Personal recommendations are a powerful tool in connecting with trusted professionals. Let us introduce you to the right people to help you achieve your real estate goals. Contact us now to learn more about becoming a member and gaining access to these valuable resources, or joining our directory of experts.